Welcome everyone. We'll start our lesson 3. Today lesson will go through LO3 learning outcome 3. As you know me, my name is Anjum Sattar. Please, if you have any questions, drop an email anjum@uversity.co.uk. I'll try my best to get back to you as soon as possible. Today lesson will go through our LO3. During our lesson 1, we discuss about the tax regulation. We discuss progressive tax evasions and regressive tax. Today last lesson we discussed about calculation of income tax, non-saving saving incomes. We discussed property. We discussed kind of benefit. The lesson will be LO3. We'll start in 1 minute, and I'll go through. If anyone any question, please you can ask. Okay, welcome. We'll start. Okay, so today lesson will go through be able to account for capital gain tax. And last lesson we had a discussion about employment tax. We had a discussion about property tax. We had a discussion about saving, non-saving, application of rates and examples. Today lesson will be focused on capital gain tax. Okay, so always good to be when we start any activity, just reflect, how much you know about capital gain tax, scale 1 to 10. And at the end of the lesson, you will see anything, whatever we learn new things, yes, so that can improve. Okay, so we have indicative content, be able to account for capital gain tax, chargeable gain, allowable assets, chargeable gain, allowable person, connected person, chattels, vesting, chattel, calculation of the chargeable gain tax, calculation of the gain and the losses arising from the disposal of the shares, and calculation of the capital gain tax, personal loan, that all will be in our discussion. So 3.1, we have that what is the chargeable gain? Is the chargeable gain where is the chargeable disposable asset by the chargeable person. Chargeable person is being the resident of the country. Okay, the chargeable person is a disposal include the part of the disposal and the gift of asset. However, the transfer of asset upon the death is exempt disposal. The person who is heritedly an asset will take over at its value at the time of the death. So individual pay the capital gain tax, and based on the chargeable gain for the tax a year, chargeable gain required 3 essential elements: chargeable, disposable, and chargeable person. So chargeable, disposables, we can look around the sale, gift, exchange, loss on destruction of asset, and exempt, disposal to charity or on debt. So rate, the lower rate of and the higher rate of the capital gain tax. 2019-20 are in this finance as well, 10% and 20%. The resident property rates also unchanged at 18% and 28%. They apply where the gain arises on the disposal of residential property is fully covered by the principal private residencies exemption. So chargeable gain at the lower rate is 10 and higher is 18, and with the basic rate tax band 37,500, now is 37,700. The higher rate of 20%, 28% where they exceed the threshold. The basic rate is extended if the person pays the personal pension contribution to make a gift aid donation. Okay, so capital gain, we can look around the resident, we can look around the as the inherent tax system, national insurance, domicile, and tax avoidance. Exempt the person, disposable asset, chargeable gain, annual exempt limit, and capital gain and the gain of asset. Per person, individual companies pay the corporation tax, exempt charities, chargeable asset, any asset which is not exempt, principal private resident, cash, motor cars, certain chattels, brewery medals which we can, gambling and lotteries, compensation, salaries, ISA, investment saving accounts, and gift, those can be exempt. Okay, chattel, the tangible movable property, vesting chattel exempt, except the useful life of the asset is less than 50 years. If they greater than 50 years, then is caravan, boats, dishwasher, TV, racehouse, and all the animal encountered in the assessment are to be taken as the vesting chattel. Non-vesting chattel sold for 6,000 or less are exempt if their expected life is greater than 50 years. Example, in teaks jewelry, then they will be taxed. Okay, so pro forma of the capital gain tax liability computation, we can chargeable gain less the current year the capital losses. If you have the net gain, we have annual exempt limit, we have no fees. Yes, so 12,570 less, it's a personal allowance. Each year we can look around the capital loss and the taxable gain. So that's, the way we can amount the basic rate, 10% amount following the basic rate band within the basic rate, following above the basic rate, that will be the higher than 10%. Okay, 3.2, explain the difference between the chargeable and exempt person. Chargeable person, individual, company, and organization. Chargeable asset, all asset under specified for exempt. Chargeable, disposable, sales, gift, or the whole other part of the loss or destruction. Exempt asset is gain, losses, example of motor car, chattels, vesting chattels, principal private shares held in investment saving accounts, betting, lottery winner, all these are exempt. Transfer the debt, the gift. Okay, let's please we look the example. So we have assuming the MN is the taxable income is 4,370, assuming the MN has the taxable income of 27,800. So CGT liabilities chargeable gain for the year 33,600 and annual exempt limit is 12,000. So chargeable gain is 21,600. So CGT capital gain tax is 10% is 2160. All amount taxable gain falls within the unused base rate 33,130. So less 430, 70. So that will be so we can look around there 33,100. Then and the tax will be first 9,600, 10%, 11,900, which will be M taxable gain falls within 33,130. So that we can look around and we can calculate. Let's please look the example, guys. So MN 33,600 is a gain for the year. Exam limit was 12,000. Now MN they have a taxable gain amount is 21,600. 10% is the tax there, and MN tax gain fall within the unused basic rate band 33,130. So 9,006. That make, so all the working you've been given here. So we can look on a unused the basic rate 37,500. Now is 37,700 less. So MN assume the MN taxable income is 27,855. So there is unused rate is 9,645. So that's 10% tax is there, and remaining will be 21,600 is total 11,955 will be, and that makes the capital get in both A and B capital tax liability for 31st January. So that can we look around. Okay, so this way we can calculate the corporation tax and part of disposal if we have, a low cost of the whole asset, A plus B. So we use the formula, the proceed part of the sold, the market value of the remaining asset. It's the partly disposal of the asset. So proceed will be any insurance damages received. If there is a no insurance, proceed will be nil and the loss will arise. And if they replace of the asset within 12 months of the tax can claim that the no gain or the loss will arise. So that can be rules we can follow because each year we've been given the rule asset being damages. If we have a loss, if the insurance is received the part of the disposal use A divided by A plus B. A is the compensation received and B is the market value of the asset's damage condition plus A. So thus we can use it to calculate the value. Okay, the chattel which we already mentioned, the tangible movable properties like a painting, dog, antiques, expected life less than 50 years and they have non-vesting expected life greater than and the year this the sale proceeds 6,000 or less is exempt if more is allowable and deems to be pay the tax. And so if is the gross we have proceed minus 6,000 exempt 5 time by 5 divided by 3 normal gain or the loss is computation. So we can connected person is the parent, grandparent, inherent and tax, brothers, sisters, and children. Okay, shares where the share of the same type of the company has been acquired through the more one purchase and the rules are needed to be identified and always disposed. The matching rule, the shares of the same type are the match for the following the same day acquisition within 30 days after the disposal acquisition is the share pool and can be used. Okay, so share pool, purchase of the number of shares, purchase of number of shares, and then we sell the share. Share pool can be carried by the number of shares sold divided by the number of shares in pool times by the cost at the date which we can. And if there is a bonus issues, 1 in 4, the share issues 400 shares would receive 100 shares free. The capital gain is treated as the follow. The bonus shares is not treated as separate holding of the shares. The share is treated as acquired at the date original shares and related to the bonus included in the share pool. Okay, so then we have the right issue shares. If you have 1 by 3, so we can get shares, 300 shares, acquire 100 shares at. So we can look around and we can multiply the shares. We can look at the 10 pound shares. Yes, 1 in 3. So if you acquire 100 shares, this costs you 1,000. The right issue is that it is separate holding share. It should be acquired the trade at the same date of the original share, and the right issues included in the share pool. So the period of ownership for greater than 100% period of ownership is great, and we can look around percentage relief, and that can be used. The period of the occupation in Dean occupation, and we can look around the total period of ownership of the share. Demand occupation, the listed 18 months, or 3 years, and up to 4 years is working in the UK. These, we can look around the period to apply. Okay, calculate the capital gain tax individual from the given data, which we can look around in that. We've been given the intakes, ways is resulted that the capital gain 18,800, 6,000 is exempt. We sold, residential properties and result chargeable gain is 39,500 and we can calculate. So 39,300 is the residential property gain. 12,000 is exempt over the limit in the year. Then we have a capital gain, which we have to other gain. We have 18,800. So we can look around the total gain. So first 27,500. If there is a no other income, 18% at the rate of 18%. So if we have capital 37,500 was the total basic limit where the tax rate is 20%, but for the capital gain is 10%. So that is the left, the 10% will be 37,500 minus 27,500 is on gain. So remaining 10,000 will be at 10%. That is 1,000. So capital gain at the 18%. Then we have the capital rate is 10%, and then 8,800 minus 10,000 at 20% rate. So taxable will be 7,710. Other gain we have 18,800. So total gain we have. Okay, so chargeable gain on the first 27,000, remaining that can be 10%, other will go on 20%. Okay, so that's all the tax rate, total tax liability will be 7,710. Okay, so that's, we have to look around the capital gain rate of each year, whichever other order of the offset, although the charging at the end of the result, interactions are the annual exempt amount, and the brought forward the capital losses has been clarified, and the annual exempt amount is now being deducted at the offset, the current year losses, but being, setting offset the brought capital losses. Note the standardized, the term, the chargeable gain and not chargeable is referred to the gain before the deducting annual exempt limit and forward the asset losses. And the term chargeable gain is the gain referred to the gain after deducting annual exempt limit, and then you can brought forward the losses. Okay, so we can look around the chargeable gain 18,000, the losses 15,800, annual exempt allowance is which we need to be 10,000, and NIM taxable gain we have. So 18,000 capital losses, so net gain we have, annual exempt is 10,000, so capital gain will be 0. And the next year chargeable gain is annual exempt capital losses, and the GAN will be the GAN can be carried forward. Okay, so guys, I included the link for you for further, you can look around the example about, and you can use any year's capital or the financial act. Better to be use the latest, which is Finance Act 2023, and we can apply the rate and we can pick the example. Thanks for attending today's lesson, and next lesson we'll go through our assignment discussion. Thank you. Have a lovely weekend. Thank you. Bye bye.